A systematic investment plan or SIP is one of the most simple and convenient ways to create wealth in the long run. Yet, some investors fail to maximize their SIP returns as they make some basic investment mistakes. Today, we will help you spot those common mistakes and tell you how can you avoid them and get the most out of your investments. For this, we have on board Santosh Navlani, CEO, ET Money. Santosh, good evening and welcome to the show. Before we slip into the discussion, I want to understand a lot of people are actually scared of continuing their SIPs looking at the higher market levels. What do you have to tell them?
Hi, Kavita. So actually, it's a quite an apt topic given the lifetime high that market is witnessing, or the new all-time high that we are witnessing right now in markets. And it's very normal, it's very human to be concerned continuing your investments in equity funds at least completely unabated and keep buying at higher levels. And in the show, we have discussed multiple times in the past that at ED Money, we don't believe that's the right way to invest. You need to take some money off the table. You need to review your asset allocation. So if you are somebody who's following those principles, you would not be worried and you would have an investment strategy in place. But if you're somebody who's actually not really aware about what the long-term investment plan is, you're not really in control of the asset allocation that you intend to be with, then you may be fearful of investing at these levels, and that's very natural. So the simple thing is, don't stop blindly SIP. Don't skip this month's SIP. Don't really pause your SIP till the time you get your plans clear. Have an investment strategy in place, and then you will not have these worries at all.
That's the most important thing. Having your investment strategy in place, having your investment goals lined up, and then going in a planned way is the basic requirement for a financial portfolio, or to go ahead with your plan in your portfolio. But then talking about SIPs, when you say people forget their SIPs or they skip their SIPs, what do we mean by that? Because isn't SIP a way to participate in equity market in a disciplined manner, and skipping it will actually dilute the most relevant reason for why it is set up?
Yeah, so Kavita, it's very apt for us to believe that SIP is supposed to be like a simple and convenient way just to continue with it without bothering too much about it. But that's something which a mutual fund company would want you to believe, right? It's in their interest to continue gathering flows. It's in their interest to actually keep having the fund size becoming larger and larger, and they would not even ask you to alter your SIP. Typically, at least will not easily allow you to go it down. But it's your money which you're putting on the table, and when you're putting that money, we all know what happened in last 1 year. If that is anything to go by, the commentary in at least second half of 2021 was quite negative. If people were quite fearful about what central banks are going to do next year when inflation is going to be at all-time high or lifetime high or 40-year high, whatever you want to believe in right now. And everybody will take some action and it will be bad for markets. And while that happened, we also got double whammy in terms of Russia-Ukraine war, which is not yet stopped. And then the escalation on the oil prices and things like it continued. So the fact is, when markets are all-time high, they require just a small excuse to correct. And if you don't book your profits, at least take some money off the table, review your asset allocation and rebalance, you would not get it right. So I would say that the problem in people's understanding of SIPs, you're supposed to have a constant amount going in a constant fund or an asset class. That's not the right way to look at it. An SIP is supposed to be your savings plan first, that you are allocating, say, an X amount, 5,000 rupees, 10,000 rupees, or 50,000 rupees per month to your savings plan for the future. And where that amount should go each month or each quarter or each year may be different. It may go in equity fully, it may go in diversified portfolio equity, debt and gold. It may go in debt and gold and not at all in equity. That's something which you need to plan for to ensure that your returns are stable, are better, our drawdowns are lesser, or surprises are less negative compared to what you may see if you continue putting a constant amount in the same fund each year.
So explain this to me, Santosh. What if someone just believes in investing when the market is correcting and doesn't want to invest when the market is at a higher level? How does this strategy impact your corpus? And also explain us, how does a continuous SIP in all the market levels actually help us achieve a corpus?
Kavita, if it was in our hands, or any human being would actually want to have an SIP run for a few years and have a bear market that point of time, and once stop investing in markets, give a bullish move, and you make a lot of money in that. But that can be more about visualization that you may want and imagination that you may want. But the fact of life is markets which actually go in both directions. They'll keep going up, they might keep going down, and you would not know what the market's mood is going to be next day or next quarter in that matter. So the right way to do it is have an investment plan where you actually are not really bothered about valuations all the time that you're investing. You are bothered about valuations only when they're excessively higher. You're bothered about increasing your allocation to equity when markets are actually quite cheap. You are basically investing in debt investments when interest rates are higher or trending towards higher side. You are supposed to have some gold in the portfolio when you believe that there is a lot of economic uncertainty in the marketplace. So you need to plan things in a way that you are invested in all markets, not necessarily in equity. The moment you understand this concept that you're supposed to keep investing every month, but not in equity all the time, I think you will become a far better investor than you can be otherwise.
Going to our next mistake, which is not increasing your SIP amount. And if you don't do that, you're almost doing like an RD in equity markets.
Yeah, so I think many people, in fact, most of the people in equities who are running SIPs right now actually are victims of this mistake, in my opinion, because we have been kind of educated or informed that have a constant amount, continue for long term in the same fund. This mistake also settles into the fact that we don't increase our SIP amounts. The simple fact of life is all of us experience, or at least most of us experience, a rising income annually every year. It may be 5%, maybe 10, maybe 15, maybe 20. But everybody does see some kind of inflation adjusted minimal increment in incomes. And that should also ensure that you are investing more for the future. What happens is, while a lot of people get increments in terms of their business income or salary, they also increase their expenses, but they don't increase their SIP. The savings basically lie down in the bank account or basically accumulate, and that money gets expended onto a larger consumption item and things like that. And if you don't really increase SIP, then you're not buying into the future. We did some analysis in the past, and if you look at data, if you have an SIP of say 5,000 rupees each year, each month, and you don't increase your SIP, you basically in like a certain amount of time will have some X value over a period of time. But the moment you say that I'm increasing my SIP by like 5%, the amount may be basically looking like almost nearly double. If you increase the SIP by 15%, it might go 2x. If you increase by 20%, you might have a 3x more corpus. So what happens is, by just increasing SIP amount by 10, 15, 20% annually, or whatever you can afford each year, can actually make a meaningful difference in the end corpus you will have. Because it's not just that SIP amount you're investing, the compounding on that will keep coming in every year as well. And you would actually make a lot of money in the future. So, if you want to achieve your financial goals, the fastest way is to actually ensure that you keep increasing SIP amount every year.
All right, that you can do as per your convenience. But then how important it is to choose the right plan within a mutual fund scheme. A lot of people, they are aware of growth and dividend plan option, but a lot of people are not aware of how choosing the right kind of plan within the scheme also helps them achieve or arrive to that corpus which they really need for the financial goal. Talking about dividend plans, why it is a mistake, or is it a mistake?
So I would say it is definitely something which is unwanted. I would not call it a mistake in a negative way, but it is far more less desirable for any investor to be having an SIP in an equity scheme or a fund, and having a dividend option selected there, or even for debt for that matter. Let's do simple calculations here. The amount you have to invest in a mutual fund, if there is a regular dividend coming in at least say once a year, what will happen is it is actually coming from your corpus, and the NAV falls down, and the money is hitting your bank account. and this amount is actually taxed at your income tax bracket. So when you are actually earning some dividend from the mutual fund company, you're supposed to pay tax on it. When you pay tax on it, there is a further loss of money, and the money that you get back in your bank account doesn't compound anymore. Versus growth plan, when you invest in a growth plan, the money doesn't get kind of come to you in the form of dividends. It keeps growing every year, and that reinvested money in that sense becomes a larger corpus. And when you sell that, you're only subject to long-term capital gains tax of 10%. Now imagine you are actually getting some kind of cash out every year and paying your by paying a tax as per income tax bracket versus actually letting the money go and compound for a long period of time and only pay 10%. You are far, far better off by actually investing in a growth plan. That's for only equities. When you look at debt, it becomes far more tax disadvantaged compared to growth plans there. Because what happens there is in debt, you actually pay short-term capital gain tax for almost 3 years. So all your money continues to be taxed at 30% straight away if you're a higher income tax bracket. And if you buy a dividend plan of a growth plan of debt scheme, what happens is you get indexation benefit after 3 years of holding. So taxation there is actually far, far less than 10% in many cases. So in both the asset classes, be it equity, be it debt, you actually are better off by investing in a growth plan and withdraw money whenever you need if there is an emergency, instead of actually having some kind of fixed payout coming in every year or periodic basis from mutual fund company.
All right, almost the end of these common mistakes that you're highlighting. We are left with not having a specific goal or a SIP oriented investment approach and monitoring your SIPs periodically. How can one do that?
So the first aspect, not having goal, basically, Kavita, what happens is when you're investing with in a random set of funds just because you believe that you need to start saving money on a monthly basis, which is a great habit to build, but not having a goal or end objective attached to it, basically makes you prone to some kind of impulsive behaviors like pausing SIP in between, skipping SIP installments in between, not really increasing SIP amounts as you keep earning higher incomes, or for that matter, actually, if there's a large profit there, you may withdraw it just because you want to feel like booking some profits or buying something of high value, which you may not be able to afford by your bank balance in that sense. So on all the 3, 4 cases, what happens is you basically end up breaking your compounding. And when you have a goal attached to it, something like a child's education goal or retirement goal, you become far more disciplined and emotionally attached to that goal. And the corpus value, the return value doesn't make a difference. What makes sense is, am I on the right track to accumulate 2 crore for my retirement corpus? Am I on the right track to accumulate 1 crore for my children's education? And that goal orientation will actually make it far more disciplined, far more, patient investor than it will make you otherwise. So I think goal attachment creates a lot of emotional correction in our behavior as an investor more than anything else. And second aspect is not reviewing your SIPs. As we discussed at the beginning of the show as well, people keep SIPing. They don't review their asset allocation. They don't review their investment plan. They don't review the fund performance. If you don't do these, then basically what is happening is your returns may be suboptimal in nature. If you continue monitoring along with your investment plan, then your returns tend to be far better compared to you would do otherwise. So these two things are actually more important on an emotional level than actually giving you any kind of tangible benefit in the short run.
The bottom line is you need to continue your SIP, increase your SIP amounts, monitor your SIPs periodically, and also opt for a growth plan. Thank you so much, Santosh, for being on the show and explaining the importance of having SIP as a route of investment in your portfolio. Thank you so much.